Okay, welcome everybody to episode 106, I believe, of the Volatility Barometer podcast. So thanks everybody for showing up today. I apologize, it has been a few weeks, but we're back. I'm actually testing a new setup as well, so hopefully everything is going well. But in a few weeks here, I'm going to be taking my wife on a trip to France. We're going to go to the Champagne region. She is a sommelier, so probably going to have a lot of fun there, have a few too many drinks. But that'll be a good time. But what better time to test the travel setup, the road setup that's much lighter. This is just plugged directly into my computer. My camera's not even on a tripod. It's just sitting on my desk. So hopefully everything goes well. If I can do this, then I can take it on the road and actually do some live streams, maybe with a vineyard or two in the background. So that'll be pretty cool. But as always, my live streams are totally free. Never spoken to any advertisers. I'll never run ads on my live streams. It's all free. Don't super chat. You can ask your questions. You can actually get those in the chat right now. We'll get to those soon. But there is the price of admission of a thumbs up for me. Let's get this pushed out to a few more people. So if you could do that for me, that would be great. And let's get started with our first segment. Okay, so of course the economy is still very uncertain. Nobody really knows what's going on. And probably in the next few weeks is when we're going to start to see some supply chain issues, empty shelves and things. So we don't really know what's going to happen. But at the very least, we can say the S&P 500 has started to recover. So right about now is probably also the time when people are looking to dip a toe into the short volatility trade. So I thought today would be a very good time to go through the three main inverse volatility ETPs, that is SVOL, SVXY, and SVIX, compare them all head to head, see how they perform, and try to figure out which one is the best one. I think there is a clear winner, probably not the one you think it is. It's actually probably the last one you think it is, but we're going to get into those numbers now. Okay, so like I said, we're going to be comparing three ETFs. The SVOL, which currently has about 900 million. It's the biggest of the three. And then we're going to do the SVXY at about 600 million. And then the SVIX around the same. And then we'll tie all of that into the S&P 500 as well with a general comparison. We'll use that as our baseline. Now, I do also want to say that I have no connection to any of these ETFs. I'm strictly going by the numbers. This is a data analysis. I'm saying this because I probably will ruffle a few feathers when I'm talking about SVOL. It's a very popular product. Now, I have a feeling that its popularity is mostly due to how it's marketed rather than the actual performance. We'll get into that in a second, but let's just see what the marketing material is saying about this product. So this is coming straight from the Simplify website. It says the SVOL seeks to provide investment results before fees and expenses that correspond to approximately 1/5 to 3/10. That's important. We're going to say about 0.25 here. The inverse of the performance of the SIBO Volatility Index Short-Term Futures Index. Now again, important, it's not based on the VIX. Even though it says the VIX, we're talking about VIX futures here. Totally different. While also seeking to mitigate extreme volatility. It says we believe many traditional sources of income are failing to meet investor needs in today's low-yield environment. I hate the use of the word income, by the way. But it says SVOL aims to provide an attractive income stream and source of diversification, I'll get into that as well, while seeking to avoid risks inherent in other income-producing asset classes. The fund's short VIX position provides investors an optimized exposure for monetizing the premium in the VIX futures market. That sounds great. And then a modest option overlay budget is then deployed into VIX call options to help protect against adverse moves in VIX. So this sounds absolutely brilliant. We can participate in the short volatility trade that everybody loves so much, but it also has a hedging component so that the drawdowns are very manageable. And the other aspect is it also does pay a very large dividend. So that's a 20% yield. This SVOL product seems to have it all. We can see net assets 900 million. Apparently a lot of other people agree. This thing is amazing. Now, if you know me at all, you'll know I have to take a very short detour here to talk about dividends because you're not actually making any money when you get dividends. If we do just a super basic discussion here, let's say before the dividend, a person had $100,000 in the SVOL. It pays a 20% annual, let's say 5% quarterly, which is big, that's $5,000. But if you notice what happens after the dividend, your equity value will drop by the dividend amount. So you'll lose $5,000, but you'll be given that $5,000 in cash. Now, at the end of the transaction, of course, you're still going to only have the same $100,000. You don't make any money when you get a dividend. You don't suddenly have $100,000 and then you get paid a dividend and now you have $105,000. They're not being really nice to you paying a dividend. All that's happening is it's being taken directly out of the stock price. That's why when you look at something like SVOL on a long-term chart, it appears to be crashing pretty hard. Going from 28 all the way to 13 at the lows, it's only 16 right now. Over a 4-year period, it looks like the SVOL is significantly negative. Now, it's not. The only reason that you can actually see it for real is if you download the data and you actually include the dividends, which of course I am doing. But the point is, you don't make any money with dividends. You're essentially taking money out of your right pocket and putting it in your left pocket and thinking you made passive income. I think the only reason dividend investing is so popular is because people just don't know that this is actually happening. Usually dividends are very small, and you don't actually see it in the stock price. But I assure you that dividends don't make you any money. It is a net zero transaction, and in fact, you could make a case that it's actually worse. Because of course, when the dividend is paid, that is a taxable event. So you would be much better if they just kept the dividend in the fund and it just grew normally. But that is a long roundabout way of saying don't ever invest in anything simply because it pays a big dividend. That dividend doesn't mean anything. It's not income. It's not passive income. You just change the name. You went from equity, you lose a little equity, you get a little cash. Again, taking money out of your right pocket, putting it in your left. You didn't do anything. But let's get into the actual data, because remember, that's all I care about. I don't care what they say in the marketing material on the website. I'm sure it sounds fantastic. And I also don't care about what anybody posts on Twitter. That stuff doesn't mean anything. All I care about is what happens in the real world of live trading. And this is the performance of all of them head to head. So of course, we've got the S&P 500, the lowest drawdown, and then it progressively gets higher along the way. But let's just narrow first of all into this first comparison between SVOL and the S&P 500. Because unfortunately, right off the bat, we do have to say that under all circumstances, the S&P 500 is way better than SVOL. We can see here, the drawdown is lower, so the hedging component with SVOL isn't really doing much, and the rate of return is about twice as high. So pretty much SVOL is a non-starter. It's got 50% higher drawdown, but half the return. There would be no point in any circumstance to hold this. And it's even worse because it does worse in both market environments. You can see it draws down a lot more than the S&P. I guess that's to be expected. But it's also significantly worse during calm periods. You can see the S&P 500 performed way better during this calm period. So it does worse in drawdowns and it does worse in stable markets. It has a higher drawdown and only half the performance. Plus the dividend doesn't mean anything. So what is the point? And look, I get it. Again, the marketing material sounds great. It's a short vol product with a hedging component and a massive dividend. It's all good. Unfortunately, there is no possible way to hedge short volatility trades. You cannot under any circumstance buy and hold. Ever. Full stop. The reason for that is the short volatility trade itself and those VIX futures are very convex. In order to be able to hedge it adequately, in order to reduce that drawdown in a crisis, that also means that during all of the stable periods, you're just going to be bleeding capital. Most of the time, hedges just expire worthless. You don't need them. You only need them in a crisis. But you can never balance that out. You can never buy enough hedges to be safe in a crash and not have it cost you in stable markets. So again, not saying this to ruffle feathers, but obviously across the board, SVOL is just a non-starter. SPY is just way better in every way. And that's not saying much because if you go on my YouTube channel, of course, I've got plenty of videos talking about this, but you can go to this one, buy and hold sucks. Buy and hold investing doesn't work. I don't think there's a case to ever be made that buy and hold investing itself is a good idea. So don't do this either. I'm not suggesting, oh, don't use the SVOL, just go ahead and use the SPY and buy and hold that. No, don't do that either. Obviously, you can be way better than that, but just in a universe of two choices, yeah, obviously the S&P 500 is far superior to SVOL. Again, I don't know why there's 900 million in under management. I suspect it is because people don't actually plot the performance. They just look at the prospectus and think, oh, this sounds awesome. But let's move on to something that's actually more relevant to us. This is now comparing the minus 0.5 times SVXY versus the SVOL. Now remember, SVOL is about 0.25, so this is double the leverage factor. Now obviously the drawdown is going to be larger, SVXY moves more, crashes more in a crisis, but you can see the trade-off is that the rate of return is significantly higher, basically 3 times as high. And since we've already removed buy and hold from the table, you can't do that ever in any circumstance with short volatility. Well, now we're just talking about tactical investing, aren't we? And in that situation, you actually want something that draws down quite a bit, but then has an exceptional rate of return during calm periods. Because there's lots of volatility metrics we can apply to these trades, and you can tactically rotate into safety. You don't have to suffer the 46% drawdown. So the SVXY just gives a far better risk-reward ratio where you can chip away at the drawdowns, you can make both of these lower, but the rate of return for SVXY is just far superior. Again, I don't see any reason why anybody in any circumstance would choose the SVOL. This is just obviously better. Now you might say, well, doesn't that mean that the SVIX, which is a -1 times product, won't that be the best one? Well, now we're in a situation where the drawdown is so substantial that it's significantly cutting into the performance. Now, it's true that during stable markets, obviously the full -1 is going to do way better than the 0.5, but the reason that you would still not want to use the SVIX, even if you're tactically rotating, because remember I said we can apply a lot and we can reduce those drawdowns. But when you're dealing with SVIX, there is that fine line where some days you're going to be in short volatility. VIX futures are stable, it's in contango, market's totally calm, no reason in the world not to be short volatility, and then you wake up the next day and something terrible happened. Those are the days that are a real gut kick if you're holding something like SVIX. You can't see them coming. It's just all of a sudden, overnight, something changes, stocks crash 3 or 4%, SVIX crashes way more than that, and you kind of just walk into this wall. So again, it's about balancing those drawdowns. I've talked about this a lot, but the larger the drawdowns you take, the longer it takes afterwards to get back to break even. So if we're talking about SVXY at about 46%, it takes 86% after that to get back to break even. That'll take a while. But at 79% with the SVIX, it's going to take 383% to get back to break even. And again, no doubt at some point the S&P 500 is going to crash 40 or 50%. Something like the SVOL will be down 70 or 80%. SVXY will be down 80 or more. The SVIX will be in the 90s. So when you're talking about something with a 90% drawdown, which will happen at some point, being 900% away from breaking even just means that the risk-reward ratio is no longer good here. For the very same reason that I said SVOL is a total non-starter, and SVXY is just better because yes, it has a larger drawdown, but the return is way better. It doesn't just keep going upwards. You don't go 0.5 is worse than 1, and 1.5 is better than 1, and 2 times is better than 1.5. It doesn't keep going like that because at some point you're just walking into gut kicks. You can't avoid them all. Markets do crash out of nowhere sometimes. You don't want to be holding something that's 1 times leverage. You certainly don't want to be holding short volatility at 1.5 or 2 times leverage. And you absolutely don't want to be holding naked short options on short volatility. Those gut kicks, when you wake up and can't avoid it, those are the ones that blow up your trading account. So I do think the SVXY at 0.5 times is the sweet spot. And that is the one that we use in our tactical volatility strategy. Anybody who says it's too watered down and you can't make a good rate of return, well, I beg to differ. It does really well during stable markets, during really long, nice trends. You can make a ton of money holding the SVXY. And then again, because we're tactical investors, we're not dumb enough to just buy and hold this thing. That's crazy. We rotate, and our safety position is actually gold in this strategy. And those obviously serve the main purpose of reducing the drawdown because you can't hold SVXY in these higher volatility ranges. But it's also not a net neutral position. Gold is actually doing quite well for us as well. You know, these are only on about 35% of trading days, but gold actually does put in some good work for us. Main purpose being to reduce the drawdowns, but also make some money and keep moving those chains down the field. When we look at the head-to-head comparisons, if you were going to buy and hold something, you would have to default to the S&P 500 because all 3 of these are going to have drawdowns that are just unsustainable. Like I said, SVOL will probably approach 70 or more, SVXY assume 80, SVIX in the 90s. S&P at 40 or 50 is not going to be a party, but it is actually the best of the bunch if you had to buy and hold. Fortunately, we don't have to buy and hold. Nobody has to do that. Why just ride something off a cliff when there's very low-hanging fruit metrics that can get you to safety? I apologize to all the SVOL people that love the product. I know it's popular, but come on. We have to take the markets and these products the way they are, not the way we wish they were. Sounds great, but no. So like I said, when we're trying to isolate which one of these is actually the best ETF, it's probably not going to be the one you think. I would imagine before people watched that presentation, they were thinking SVOL would be the best, SVIX would be great for people who want to take on some extra risk, and the SVXY, really no purpose, it's kind of stuck in the middle. But as it turns out, it's the SVOL that, in my opinion, is a total non-starter. I mean, why would anybody hold SVOL when the S&P is way better already? And it's not really a full-on short vol ETF because it performs so poorly in good markets as well. But people probably thought that the SVIX would be better than the SVXY. But in my opinion, the benefit that you get by having a little bit watered down product so that you don't end up taking 2 steps forward and then 1 giant step back every time the market shocks you. I think in order, SVXY is by far the best. Then I would say the SVIX for people who know how to control risk. It's not as good as SVXY, but it's still fine. And then in last place, unfortunately, I apologize to all the dividend people out there, the passive income that doesn't actually exist, of course, because dividends are not making you money. But my apologies, SVOL is the worst of the 3. So there you go. If you are planning to buy the dip in this environment, now the VIX futures are sort of heading into contango again. Like I said, people are probably looking to dip a toe. And I would say focus on the SVXY, learn how to make money with that product. It has a little bit of built-in risk management, so you're not going to get crushed when you make mistakes. And actually, you can make a really fantastic return if you know what you're doing. So now, quick word from our sponsor, and then we will get into the open Q&A. So we'll get to the live Q&A in just a second here, but I launched VTS all the way back in January 2012 with 2 main goals. First, to crush the financial industry and help investors start making real progress towards their retirement goals. And secondly, to provide that outperformance at a much lower cost. A low monthly subscription fee scales far better than paying a traditional percentage of assets. Now, our portfolio is currently 4 strategies with low correlation to the stock market and to each other, so it's a completely diversified total portfolio solution. It's also not active day trading, and trust me, anybody from any background can follow VTS in just a few minutes a day. Since retiring from pro golf in 2005, I've been an options and volatility trader for over 20 years now, and I share a lot of invaluable volatility data in every daily email to subscribers. I'm also a certified workaholic, and there's a growing list of courses that all members have full access to. There's a free trial to VTS on my website available to everybody. Come join members from over 70 countries around the world. I can definitely help you achieve your financial goals. Now let's get into the live Q&A. Okay, so now that all the SVOL traders hate my guts, all the dividend people are really angry with me, we can get into our Q&A. So of course, off topics are always fine. We sometimes go off on little side tangents, but overall, you know what I do, tactical investing, a lot of volatility trading, options trading. So fire your questions and let's go. But one thing I do want to say though, I've got such a growing list of topics to get to on my live streams. Originally the plan was to do 1 per week, and sometimes I get really busy. I don't even do that. But the topics are just piling up like crazy. So I'm going to have to start cranking these out a little bit more. And what that probably means is I should shorten the Q&A. Sometimes I stick around for 2 hours, 2.5 hours. We should probably limit those so I can just do more of these, because I'm never going to get through the list. Every time I do a live stream, I think about something new that I think, oh, people think that's a cool topic. So yeah, let's kind of tentatively go for 45 minutes to an hour and see how many of these we can get through. So I will get all that off the screen. These are just my basic interests. But let's start at the very top. Hopefully that's the top. So can you comment on where we are in the economic cycle? Whether you think a major drawdown crash is near, and the fact that Buffett's cash position is at a historic high. So the one thing that I will always mention with these types of questions is nothing that I actually believe that happens in the market macro is going to affect my strategies. I don't wake up in the morning and decide what I'm going to trade that day. I don't look at the market and say, well, Trump's Trump's kind of a wild card today. I feel like, maybe Besant has a meeting at 2 or something, and it's going to be a bad headline. So let's do something else. I don't do that. I'm entirely systematic, quant-based. The numbers are based on the data. So what I personally believe about the market will not sway what we actually trade. It's just, for me, I got a lot of option strategies that are discretionary. And then I like to stick to the tactical strategies that are just 100% decisions out of my hands. I wake up in the morning, about 30 minutes, input all my data, spits out the trade signals, and I take those. So whatever I'm going to say about the overall macro picture, it's just an opinion. It's just not going to sway anything. But I would say just my hunch is that probably the lows are not in for the year. And the reason that I say that is probably the very same reason you're asking this question, is the economic data is going to start to be miserable. As soon as we start getting real numbers come out, right? The first couple of months of Trump's presidency, he's sort of been able to say, oh, this is all going to work out great. And he's talking about how inflation's way down and gas prices are way down. He's not really explaining why that is, right? Gas prices are down because we're basically heading into a recession, and that's what happens. It's not a good thing that gas prices are down. But once the hard data starts coming in, it's going to be pretty miserable. And then, of course, we've got the empty shelves thing we have to deal with. A lot of the ports are empty. Stuff's not coming in. And even if there was some stroke of miracle with all of these trade deals announced, it's still going to be a delay of a month or two while you can reload those ships, if they do it at all, because when policy's bouncing around back and forth, you have to understand that, I don't say this to, insult the Trump administration specifically. This applies to all governments, basically, the Biden, the Democrats, all of it. It's kind of the same. You're talking about mega millionaires running the economy. Like, all of these people are so rich. None of them have been to a grocery store in 40 years. None of this affects any of them, right? So they're kind of saying these things and doing these things, thinking that what's in their head as a billionaire is how small and medium-sized business owners will react. And that's just not the case. Small business owners especially, but certainly right up to the mid and even high business owners, they have to make decisions based on their bottom line. And oftentimes their profit margins are, somewhere in the 5 to 10% range. The average profit margin for the roughly 33 million businesses in the United States is about 8%. So it really does matter that they can make decisions, load up those ships with the inventory they need based on the fact that they only have about 10% of wiggle room. And if they get it wrong, it could be very, very costly. So even if Trump announced a wave of new trade deals and all of the tariffs came off and they all went back to the very beginning, you're still facing about 15 million business owners out there that are still not going to have any idea, is this going to stick for 2 weeks? Is this the new policy for 6 months? Is this the direction we're going? Nobody knows anything. So that's a long roundabout way of saying there's been an incredible amount of damage done to the economy. And I don't think this is a quick fix. So for me personally, I think that maybe in the next few weeks, things will continue sort of bleeding upward like we've seen. But at some point, the data is going to start to freak people out. And we don't know how the market's going to react. Once we start seeing the hard numbers, and who knows, right? The market may just slough it off like it has for so many years, right? This has been an incredible buy the dip environment for years. I don't know if that's going to happen, but I do know that the data is going to be ugly. How people respond to it, we will see. But as far as Buffett's cash position, I would never make decisions based on what any individual is doing. I do my own thing. I stick to my own metrics and I have my own systems. But I do think that at the very least, this is somebody who has a track record of having patience and seeing the macro picture. He doesn't trade the same style that I do. So yeah, if you've got somebody of that stature with that specific mandate that he tends to follow, and he's not seeing a whole lot of good deals out there, and he's thinking maybe we should build this cash position. What is it, 350 billion at this point? Yeah, I think they're probably seeing the same thing. We want to see what happens in 6 months, right? We could very easily just blast right through all this tariff stuff like it never happened, and maybe the markets are up 10%. But the data could be completely miserable, and we could definitely go into a prolonged recession because of this. Honestly, I think that odds-on favorite are that we're going to see multiple quarters of negative GDP and probably substantially negative. This is terrible. This is really, really bad. So that's my thoughts, but of course it won't affect my positions on Monday. I will still be data dependent. Check the volatility metrics and we'll see. We're currently positioned so that we're kind of hovering right around that middle range where we're going to start to shift soon into our aggressive positions. So barometer at about 78%. We're still sitting in gold. Gold's been treating us really well for basically almost a year now. XLU's fine, maybe move into the NASDAQ soon. And IYR Real Estate's fine, maybe move into Berkshire. So that's interesting. You mentioned Warren Buffett there. We just recently switched from SPY into Berkshire for probably a fairly similar reason. I explained in a blog article, but yeah, I like the cash position. I think that Berkshire's done very well the last 10 years, and it is slightly better than the S&P 500. So there you go. I don't know, but I think we're going lower soon. Within a month or two, I think we're going to test those lows again. All right. So as to not buy all in one day, but try to buy on dips, but at least not have the risk of the underlying price being solely determined by when the one time of purchase happened to be. I get the point there. I think it could use some punctuation, but I'm not going to be too picky. I get what you're saying. Is there some sense of tiering into positions from the daily trade signals email? So this is a good question. I like this one. Essentially, you are asking, let's just say, for example, we go from the GLD into the SVXY on a day 1 week from now. If that were to happen, we go 100% out of gold and 100% into SVXY. With this allocation, it's only 25%, but we would shift 100%. Your question is, should we maybe do half-half or a third over a 3-day period? The general answer is no. I have done testing on every type of combination, and it is always better to get in with all of the money on the day the signal hits. It just quantifiably speaking, but also just intuitively, right? You got to remember what I'm doing. This is going to sound bad, but I'm not actually trying to predict tomorrow's market, right? Let's say I did go from gold to the SVXY. I'm not necessarily saying that SVXY is going to go up tomorrow and gold's going to go down tomorrow. That's not what that means. Essentially, what it would mean is, based on the level of volatility through all of the historical data going back 20 years, this level of volatility favors this ETF on balance of probability. Not every time. Of course, we don't hit 100%. We have days where I move into something and it immediately that day goes down. That happens. But what I'm saying is, given where we are right now today, this is the best ETF to hold. So it makes sense, both quantifiably, the numbers work out the best, but also intuitively, why wouldn't you just put your money in the best position? Doesn't mean it's going to work, but that is the best way to trade. And then you just let the law of large numbers over time, many occurrences over many months and years, and then it works out. You're typically, on a 1-day time frame, it's maybe 60-40. Probably it's going to work, but 40% chance it goes down the very next day. Over 2 days, maybe it's 65-35. Over 3 days, maybe 70-30. You get the point. The longer the signal goes, the more robust it's going to be. But I would still always rather have all of my money in the best ETF on that day. So no scaling in or out. Hopefully that answered that. All right, in updating the volatility barometer, what is the comparative difference from 60% of how it was formerly constructed to the 60% it would be with this new construction? So little backstory for anybody who didn't read my blog recently. The volatility barometer has made a slight change. So in the past, let me go down to an actual chart here. In the past, I had the barometer set up so it's just measuring percentile ranks, and the way that I mix it all together, it was 13 different volatility metrics. Not all of them are going to point to 100% bad. Let's say at the worst point in COVID in 2020, even though it's 13 volatility metrics, not all of them are going to be pointing that that's the worst day. Some of them, a couple of them anyway, have a little bit of contrarian in them. So they wouldn't always rank that. So the old barometer before just this last week would never show 100%. The highest ever was 91, the lowest ever was 13. I have reworked it a little bit just this last week to show that actually the worst day was March 16th, 2020. But what is important to know, and this gets to your question, is that this is just purely an internal calculation. I just added an extra layer of calculation just to expand the window so that it does go to 100. And the lowest ever, it should go to 0, but my metrics go back to 2004 and the barometer launched in 2011. So actually the lowest levels turned out to be about 2005, 2006. So that's why currently it doesn't show 0, but it could. It's geared to show 0. And so generally, visually, it's going to look what people intuitively expect. 2 weeks ago, volatility should say 99.9, but my barometer said 91%. People think that's a little bit weird. So I just went through and I recalculated it all. It doesn't change the signals at all. No performance changes, no signals change. It would be the exact same strategies going back. I simply added sort of a calculation on top of the other calculation to make it visually try to hit 0 and 100. So 60% level, it's not exactly the same. Like 50% level is going to work out about the same. The 60, you might notice slight differences, but you got to remember that when I reworked the barometer, I also moved all of the indicators as well to match. So they didn't look like this last week either. These little line breaks were in different spots, matching the old barometer. Now the new barometer, it's going to look like people would intuitively expect. If volatility hits the absolute highest levels, yeah, it's going to say 99.9. If we ever do top the COVID bottom, it's going to say 100 again. So long story short, doesn't affect trading in any way, shape, or form. It is purely a visual change. But it's about time. I mean, the only reason I took so long to do it, for me internally, I just look at it as it is. But I have so many YouTube videos talking about the barometer that I just didn't want to have that break. But I've just decided I'll just deal with it. When the questions come up, I'll just deal with it. And eventually, over the next few months, people will understand that there was a change, but it was visual only. Didn't affect anything. All right. What do we got here? What about REITs in theory? I have no idea what this is referencing. Unfortunately, that's your only question. There's nothing before. So my software occasionally will skip questions for some crazy reason. So maybe this is a part 2 of something that I can't see part 1. What could that be about? What about REITs in theory? I mean, I was talking about dividends. It's possible you posted that after I was talking about the SVOL dividends not doing anything. Dividends in all stocks, all ETFs, all REITs, all MLPs, all volatility ETFs like SVOL that distributes, SVOL distributes, all of it is the same thing. You're taking money out of one pocket, putting it in the other. There's no benefit to a dividend. I'll die on this hill. I am so sick of these dividend investors on Twitter showing their portfolio and saying, I have $1 million dividend portfolio. It produces $84,000 a year in passive income. No, it doesn't. If it gives you $84,000 that year for your dividends, it means your equity value dropped $84,000. That's what that means, literally on the exchange level. This is not something that we think maybe we'll do it. Maybe it's a buy and supply and demand market. No, the ETF or the stock, it actually drops price on the exchange. It has to, right? Otherwise, you just jump in there and you just buy the dividends before they get paid, and it would just be the easiest thing in the world. So you got to think about dividends from, honestly, that probably isn't even what you mean. So this is a side tangent. This isn't at you. But you have to understand, too, that let's take Twitter, for example. You see 1 million people talking about dividends as if it's free money and passive income. How many actual investors, not Twitter gurus, actual Wall Street investors real short volatility fund managers, actual fund-to-fund managers who are doing this legitimately with a big book of clients, how many of them have you ever seen mention dividends? None, right? Nobody on Wall Street posts that I have a client in $1 million portfolio and they get $80,000 in passive income. It never happens. Well, why? Well, because actual investors understand what dividends are. They are literally just exchanging equity for cash. You're never going to see them talking about how they made money because they got paid a dividend. It's never going to happen. The only people that talk about that are people who don't know what a dividend is. And unfortunately, there's millions of those people. They're all over Twitter. They have no idea what happens when you get a dividend. They actually think that the company keeps its value and then they gave you a bonus cash dividend. They actually think that. They don't know that that comes out of the retained earnings and the book value of the company drops. They don't know that part. They just know that the dividend gets distributed. And because dividends are so small, it's typically, 0.5 or something every quarter, they don't actually see this happening. But all you have to do is just look when there's a special dividend, some massive dividend, a 20% dividend. Yeah, the stock price chunks down 20% the next day. So, yeah, I don't know if that has anything to do with what you're saying, but it's just, this is such a personal pet peeve of mine, just watching an endless stream of dividend investors mislead people. Like, could you imagine thinking that you could reach 50 years old and $1 million portfolio and you can retire and now you can just spend your $84,000 a year? Can you imagine making that investing mistake? Right? That's what's going to happen. These people are going to follow these dividend investor gurus off a cliff. But what they don't realize is if the stock market is flat, you lost $84,000. You're only going to have $926,000 at the end of the year, or 16 at the end of the next year. And if the stock market's flat or down, your equity's continuing to drop. So you better not be spending your dividend money because your equity portfolio's tanking. So, I feel bad for them that they're going to get to that end point of retirement and they're not even understanding what's going on in their account, but it's going to happen. This is why we're in a retirement crisis. This is why half of people live paycheck to paycheck. This is why people don't have enough money. The average person in the United States has $240,000 in retirement. This isn't the only reason, but this is one of the reasons. Lack of education. They're just chasing the wrong things. They don't understand how these things work. So, yeah. Dividends, if you're on my live streams, you know that I rant about this all the time. I would like to save people from making that mistake because you're certainly not making an extra penny when you get paid dividends, unfortunately. Wouldn't it be easy? Wouldn't that be great if you could? You could just bounce around, claiming dividends in different stocks. That would be amazing. Nope, doesn't work that way. So now let's move on. That was a side rant against somebody who didn't even ask that question. All right. I owned a bunch of SVOL over the past years. Okay. Are you mad at me? I unloaded some before things tanked, but yeah, it's not great. Okay, good. I'm anticipating a few people mad at me because they're going to disagree with the dividend part of it, even though, got to tell you, I'm right. I use SVXY for short-term buy-the-dip situations. It works rather well. But when I write the Kelly criteria for the overall edge, I find that I shouldn't allocate more than 10% of my book to the trades. So second part, I think that's fine. I typically say no more than 20 in any specific strategy. So 10's fine. 10 to 20 is the maximum you would ever do. The buy-the-dip part concerns me a little bit. So I don't know how closely you follow my YouTube channel, but let me just go in there. Hopefully it doesn't start talking. Oh, I didn't put screen share. Go to my YouTube channel. Maybe you did already, but literally just the latest video. That's ironic that you said that. Don't buy the dip until you watch this. You got to watch that video because the part here where you mentioned that you use SVXY to buy the dip, I hope you don't mean like when the stock market is crashing, because when the market is crashing, that actually means that the roll yield in the VIX futures market is going to be significantly negative. So when you're buying the dip with your SVXY, it is way less efficient than just using equities, right? You could even get away with using 3 times the S&P 500 and it would move the same as the SVXY. So if it goes up and you're right, you buy the dip and it works, you're going to make more money with the UPRO than you will with SVXY, way more. If it goes down, you'll lose about the same, because under normal conditions, the SVXY is about 1.5 leverage to the SPY. So it is a little bit leveraged, but because the VIX futures will be so heavily in backwardation, it's actually going to get devastated even more. And so you never, ever buy the dip with short volatility. You will always buy the dip with equities. If it's like the actual dip, the markets are still way down, VIX futures are still negative. If you want to dip a toe, you have to do it with equities. And then when the VIX futures sort of settle and it becomes calm again, at that point you cycle into your short vol positions, because those do better during strong, calm markets. So you kind of want to have the idea that during really unstable markets, equities are way better. During good trends for the short vol trade, super low volatility, long trend, SVXY is way better than the SPY. So yeah, I don't know what exactly you mean by buy the dip, but don't literally buy a negative VIX futures dip with SVXY. That's a very, very inefficient position. All right, SVIX is my secondary long volatility instrument. Shorting it is way less dangerous than going long UVIX. In my investment life, I've only made money with long volatility products. Okay, products. I thought you meant you've only ever made money being long volatility. That would be crazy. Well, not crazy. I mean, it would just be odd. Short volatility is much easier most of the time. Let me think. SVIX, you're shorting SVIX versus going long UVIX. I mean, I hate them both, right? Like going long UVIX is always a terrible idea because nearly always you're going to get the timing wrong. It's very difficult to thread that needle. So when I go long volatility personally, I actually do it with just the VXE or the VIXM. These are midterm M4 to M7 products that move really slow. I don't even like to use the VXX, which is just 1 times. You're talking about the UVIX, which is 2 times. That is an extremely difficult trade to make money on. The vast majority of the time, you'll get the timing wrong, and you'll just be bleeding capital down. And then by the time you time it correctly and you get the VIX spike, you're going to be down so much money that you're going to need basically COVID to get back to break even. So, and then on the flip side, shorting SVIX, shorting anything is always a bad idea for multiple reasons. It's just, yeah. I don't ever short the volatility ETPs directly. First, there's big fees involved because you're borrowing shares to short, and it's not cheap. This is many multiples more expensive than standard trade fees for some of the other option trades, so this is always a major headwind. Second, they're not always available to borrow. You might think you've got a great trade setup that you want to jump in on, but if there's no shares to borrow, then what does it matter? Third, you can have your shares called away on you at any time, so you're not really in control of your own trade. Plus, you should know that the time where they are most likely to get called away on you is when you least want them to be. Probably it's going to be when you're doing damage control on a trade that isn't going well, and you might want a little extra time to fix your trade, but you're not going to be able to because the shares get called away on you. And lastly, and probably the biggest reason here, when you short shares, you have unlimited loss. We're talking about volatility ETFs here. They can spike up hundreds of percent, maybe 1,500, 2,000% if you're talking about the UVXY. Why on earth would anybody trade unlimited loss when one flash crash will wipe out your portfolio? Okay, that's convenient. Hopefully that played correctly, but I can explain it way better in a 40-second clip than I can. But yeah, I get your general point, but I think obviously going long UVIX is way, way too much risk. It's just being a contrarian trying to make money long vol it's not where it's at. And shorting SVIX, while I get your point that the risk is less, it's actually not a good trade either, in my personal opinion. What do you think about using out-of-the-money put credit spreads in SPX as opposed to short vol ETFs? The spreads would be a form of shorting vol with some positive delta, but also have tax advantages. So, I mean, as far as the taxes go, I don't do anything ever in my portfolio for tax reasons. I just assume that the best thing to do is make the highest rate of return. And if that does happen to mean that you pay a little bit of extra taxes, you pay short-term capital gains, then that's what you do. I don't ever want to fall into that trap of thinking, well, I should do this with my portfolio, or I should exit this position, but I kind of want to just buy and hold so I don't get taxed. This is the whole problem with the financial industry and why people are trapped. They get into these IRA accounts, the 401k accounts. They try to get short-term capital gains out of their portfolio. They do their tax harvesting. And what ends up happening is you're just very limited in the strategies you're able to do, and your rate of return is way lower. So I actually have a video on my YouTube channel talking about the difference between active trading, paying short-term capital gains versus long-term. It's not nearly as much as people think it is. So I don't worry about taxes. As to the first part, there would be nothing wrong with using a strategy for credit spreads. I would just say that it's not a replacement for trend following. These are totally different strategies. They will behave differently because, of course, the credit spreads, this has theta, this has vega, this has a time element. It's just not the same trade. So no problem running both at the same time. Dedicate a little bit of your portfolio to trend following with ETFs or stocks, a little bit of your portfolio to, harvesting some of the credit. Nothing wrong with either one of those, but they're not interchangeable, if that's what you mean. All right, I'm a new member to VTS. Welcome. Hopefully that means regularly tuning into the live streams. Big fan of your trading lessons. My fund does not allow trade in SVXY or SVIX. Ouch. What alternative would you suggest? UPRO, QLD? No, my suggestion, it's not as hard as you think it is, so don't immediately shudder when I say this, but in every daily trade signals email to the community, you will notice this bottom part here. It says, for those who prefer or require options instead of the ETPs. Sounds like this is you. You can't use SVXY, and you can't even do half allocation to SVIX. Well, you're out of luck there. But fortunately, long VXX put options, long-dated long VXX put options is basically the same position as SVXY. And of course, we change the positions. We don't let them go inside 75 days so the theta doesn't bleed away at the trade. But you can go into the stock replacement course. Let's see if I'm logged in. I should always log in before. Yeah, there's a little mini course here. It's not very long. You can go through it, and it will basically teach you exactly how to do this. And again, don't shy away from this. It's way easier than you think it is. And then as soon as we get into the SVXY on that day, you'll notice in the email, there's going to be, instructions. It's going to say, buy to open the 20th of August, 2025, long VXX 24 put option, something like that. And then you're just going to jump into that instead. And it is actually the same position because SVXY is a 0.5 times product, and we use roughly 0.55 to 0.6 delta VXX put options, which you could use 0.5 delta, but then as the trade goes on multiple days, it gets watered down a little bit. So I tend to use 0.55. It's the same thing. So you're in luck. And you can trade long only options, individual leg options with level 1 clearance. So you don't even need high level 4 to do this. And you can do these in IRA accounts, in cash sheltered, deferred accounts, all of that. So you should be fine. And if you're European and that's the reason why you're subject to those MiFID II regulations, again, long put options, even Europeans can do those. So you're in luck. You can still short volatility. It just, you're going to have to follow those instructions. Or just email me the next time we get into the SVXY and I'll walk you through it. Okay, so what time is it? Let's keep an eye on the time. I did say 45 to an hour. Okay, we're racing through. Do you use for yourself sites like Option Omega or Option Alpha? I like Option Omega to trade zero T strategies, or do you do manual hand way? So this is interesting. So I use the back testing tools just to get some ideas and sort of tweak things a little bit. But when it comes to actually doing my zero DTE trading, I've only been doing it for 2 years. I'm probably in the same boat as almost everybody. really, it's kind of a new thing. There was always zero DTE stuff, like occasionally you could get them lining up on the right calendar days, but it is kind of new for all of us that there's literally one every day. So I've only been doing this for about, 20 months, 22 months, and I'm still fully manual. Now, there's nothing too complex about my zero DTE strategies. They could easily be automated, but I've talked about this a lot. I don't like to automate things because I feel like I'm losing so much of the education when I do that. When you go in and you manually input trades, and when you go into your spreadsheets and you manually input data, instead of just having it import from somewhere else automatically, and then have your strategy just trade automatically, you're not learning anything. You're not watching it go. You're not getting a little notepad next to you and writing down cool things like, oh, wow, that data, I wouldn't have looked at it if my spreadsheet imported directly, but because I do it every single day, I'm seeing little changes and patterns and correlations. And so I'm still definitely in the learning stages, and I don't want to automate anything, even though it's totally possible to do. I think it's possible that some of my edge over the last 20 years investing is because I do everything old school, long form. There's definitely tools out there. You can go on a backtesting software and you can say, hey, what happens if you trade 10 delta straddles 45 days out and you close the trade in 7 and you hit the button and it tells you would have made this profit. Okay, great. But that's not going forward. That's just what happened in the past. But then you get in there and you live trade it automated. You don't grow that strategy. You don't expand it out. You didn't learn anything. You didn't say, maybe we could tweak it a little bit. So I think it's a trap, personally. I think it's a terrible thing when people automate their trading. Probably even on a really busy trading day for me, I've got 3 tactical strategies. So we've got all of these. I've got my iron condors here. And then I've got my VIX option strategy, which is roughly 20 trades a month. And then maybe 4 or 5 other option strategies that happen almost every day. And then zero DTE, I tend to run 3 or 4. I would say all of them combined, literally, even on a heavy trading day, I'm not trading for longer than 1 hour. I mean, and that's a lot. Usually it's 30 minutes, 45 minutes. It's not asking much. But the amount that I learn from doing everything manually, it's just invaluable to me personally. I'm nowhere near the stage where I would automate anything. I just like to see it. I like to see it play out in front of me. I like to see every data point. And if it takes me an extra 30 minutes to input stuff, okay, fine. Do I really need to save 5 minutes in my zero DTE? I've got 5 minutes, right? I do this for a living. So if you happen to have a job or friends or hobbies or family or something that keeps you that you literally can't log in, then sure, you've got no choice. But if you've got a free hour to trade manually, I would suggest you trade manually. Do you use Kelly criteria? No. To determine what fraction of overall bankroll we should be allocating to VTS. No, I'm my own risk manager. I just calculate based on my own strategies. What do you recommend based on quantitative models? Well, in order to allocate correctly, it is really one of the most difficult things in the trading world. One of the biggest value adds for following somebody like me is that, right? It's not all performance. It's not all education. Some of it is knowing how to do this and knowing how each strategy fits in relation to each other. This is something that people often overlook, and it tends to get them into trouble during drawdowns, right? People realize that when stocks crash, 90% of everything out there, all assets, all equities, all strategies, they're all kind of correlated to each other. And then they think, well, I had this massive diversified portfolio and the whole thing crashed, right? That tends to happen to almost everybody. So for me, I know my strategies and all the intercorrelations so well that I'm able to avoid doing that. But in order to get that calibration correct, you really have to know a lot about what you're trading. So when you're using things like it's just a general Kelly criteria guide that's going to tell you these things, there's a lot of inputs that you're going to have to know more than just that, right? It's really a difficult process. So I'm not sure I could recommend to anyone else because I don't know what you're trading, but I would have to know the details of all the correlations of everything you're doing. And then I could sort of help you build and put it together. But there's no rules you can say it should be 20 this, it should be 30, 20, 10, 5, 5, whatever it is. It's just not like that. It's all based on how they move in a crisis. And stuff like that, it's not going to tell you that. What time frame rolling window are barometer signal based on? Currently, this is a good question because it's going to change over time. But right now, it is going back all the way to 2006. July 17th, 2006 is when the data starts. And then the first signal, because I need, 5 years or something like that in order to percentile rank everything, I start the barometer on the 11th. But the data is coming from July 17th, 2006. Now, that's important because eventually the old market is not going to be useful to us. So fortunately for now, we have a very short window of volatility metrics. You might think, 20 years, that's a long time. It's not really, but I don't want to stretch it further than 20 years or even 15 because markets change. Obviously, the market now is way more manipulated, way more Fed dependent, way more news headline oriented, way more Mag 7. So it's not really, even if we had volatility data from the 90s, I wouldn't use it, right? It's just not useful. And so right now I'm using just starting on that date in July 2006. But if I start to feel like the current market, let's say in 2029, it's no longer any resemblance to the market that crashed in the financial crisis in 2008, then scrap that, start in 2012 or 2013 and roll forward from there. But right now I am at a rolling position going back as far as the volatility metrics go, because it's really not that long, 20 years max, right? The VIX existed back to 93, can back test it to 86, but the VIX is garbage, right? I use far more metrics than just the VIX. So right now, rolling back to July 2006. I think right now the market is similar enough to the financial crisis that I think it's still very useful data. I would still like to use that. Saying that fund managers and high net worth investors don't consider the benefits of dividends, don't account for dividends in the overall net worth of a portfolio is objectively false. I think I wouldn't say you misunderstood. Maybe I misspoke. My point was you will never see a legitimate asset manager telling clients that they made money based on the dividends. That's not what's happening. If you want to hold a portfolio that pays dividends, great. But nobody is going to, no actual asset manager is going to go on Twitter and say, my clients just had a dividend date and they just made a bunch of money. It's never going to happen. They're never going to make a TikTok saying the same things that I've criticized all these TikTokers for. I used to do these social media fail things where I'd play the thing and they'd be like, April 20th hit and I just made money. I didn't do anything. I just sat there and boom, I made $2,000. You're never going to see a legitimate asset manager say that because that's not what happened, right? You didn't make any money on dividend day. So that's what I meant. I didn't say, or at least I didn't mean, that you will never see asset managers holding stocks that pay dividends or holding portfolios that are higher in dividends. Of course, the great Warren Buffett. Now, his isn't really accurate because he can negotiate high preferred dividends. It's not the same thing as the regular people. So I think it would be I think his portfolio would look a lot different if he wasn't Warren Buffett and he could go in there and negotiate super high yields on preferred dividends. But the general point is either I misspoke or you misunderstood me. I didn't say dividends themselves are to be avoided. I said the concept of dividends making you money is never going to be my analogy of taking money out of your right pocket and putting it in your left, that's exactly what's happening with dividends. You are losing equity, you are gaining cash, and it's a net zero transaction. So Bill Ackman, he might hold stocks that have dividends that pay dividends, but he's never going to make a TikTok saying that his portfolio made money because of the dividends. That would be lunacy. Now, He's kind of lost his mind in the last few months. Maybe he will start making those TikToks. But as of now, I stand by my statement that the only people that talk about dividends as passive income and free money are Twitter gurus. Legitimate people who understand the process of what's actually going on. A dividend is just an event. If the stock pays a dividend or doesn't pay a dividend, it's totally irrelevant to me. If the dividend stays in the stock, maybe they can use that retained earnings to buy other companies, buy up a few of their competitors, increase their market share. That would be better use of capital than just giving it out in a dividend that is a taxable event to the person who gets it. They could keep it in the fund and they could buy back their own shares. That's more efficient than making the client who got the dividend pay the tax on it. So the dividend itself is a non-issue. You can invest in stocks that pay dividends, but don't ever invest in something because it pays a dividend, right? That would be totally silly, right? The dividend is just like any other any other day, like dividend day, ex-dividend day, nothing happened. It's just a regular Tuesday. No money was made, no money was lost. It's just, there it is, dividend day. It's just a name, right? That's what I meant. I didn't mean that you should construct your portfolio to avoid dividend paying stocks. No, like I would prefer higher growth stocks that don't pay dividends. I think it's more efficient. But, if you want to hold Coca-Cola, they're paying dividends. You can't say no to that. You just get them. But on next dividend day for Coca-Cola, you didn't make any income. Sorry to break that to people. To buy SVXY when VIX is over 30 and sell it when VIX is less than 18 is a no-brainer move. Screenshot. I'm going to test that for you. Have you run the numbers on that? Because that's something that is extremely easy to just show a back test. So in a future live stream, we're going to circle back to this. Obviously, I don't know how it's going to look with those specific numbers, but we'll see. We'll see if we can see what that looks like and then maybe improve on it a little bit. To stay in QQQ UPRO when VIX is under 16, no-brainer too. I would agree with that. I hate the VIX, so I'm shying away from even commenting because the VIX itself is so terrible. You got to remember that the VIX is not, it's called the Volatility Index. It's not measuring market volatility. It's not even close. It's just measuring options activity on the S&P 500. That is a tiny percentage of the actual directional exposure of market participants. So to try to think that the VIX itself is some good filter, and I'm not hacking on you, I just mean in general, it is not. It is one of the worst volatility filters you could apply. Even just M1, M2 VIX futures contango is a million times better than the VIX on its own. So yeah, I would shy away from the VIX as a standalone anything. But under 16, I will agree. Under 12, now we have a debate, because the lower it goes, the less benefit there is to staying in long equities. That is, side note, one of the reasons why our defensive rotation strategy actually cycles out into bonds. When the volatility gets that low, it's very rare, it doesn't happen very often, but when it does, in that sort of bottom 15% of the super low volatility, it's no longer beneficial to continue holding QLD. It's just 20-year treasuries does better than QLD at the very bottom range there. This whole range is pretty large, and that's about 64% of trading days. That's where the sweet spot is. But above that, terrible, massive, massive drawdowns. Below that, there's no benefit. Because you got to imagine what's happening if volatility gets so low that it's in the bottom 10th percentile of all values going back to 2006. What does that mean? Does it mean that it got there in 2 days? Probably not. It probably means that it got there over a 3-week or month and a half process of slowly grinding higher. And by then, the equity markets are probably looking for a short-term pullback. They're running on fumes at that point. And if you exit out of the QLD after a 6 or 8 week stretch of volatility just trending lower, by the time it gets to that low range, you might find that gold or treasuries does better than equities at super low volatility. Short vol, not the case, because remember, short vol is trading at least half based on the roll yield in the VIX futures market. So even if it's running on fumes, shorting volatility, you are still getting the benefit of those futures rolling down the curve, even though equities themselves probably not going to move much. You get that sort of topping process where equities kind of stop going upwards, but short volatility can continue to go upwards. So that's why, sort of follow-up question, that's why there is no low range for our volatility strategy, because SVXY can still make positive gains even when volatility is super low. But equities, there's really no point at that point. Okay. Asking. This is probably people chatting amongst themselves, which is good. I was just asking because I can't find a broker that allows me to buy SVIX here in Portugal. Okay, hopefully someone can help you out with that. If you can't, then refer back to my reference of the VXX put options. It works just as well. If you're trying to simulate SVIX with VXX put options, you're going to have to buy twice as many contracts. So I would do the 0.55 delta over 100 days to expiration, 100 to 130, 0.55 delta, 2 contracts. Remember, options are super efficient compared to the underlying, so you can definitely do 2. And then that gives you a 1.1 delta on the VXX, which is roughly the same thing as SVIX, give or take. I use 0.55 because I'm using the SVXY, but stock replacement works awesome. Okay, and more Portugal stuff. Unfortunately, I can never be of any help to people in the European economic area because I don't have access to any of the brokers. I don't know the tickers that you guys use. I don't know what's allowed and what isn't. So if you can help each other out, that would be fantastic. The other thing I always say is if you do live in those areas that I just can't be of any help to you, then it might be worth it to just pay for an hour or two of an asset manager's time, just fee only. Just give them $800, whatever, $400 an hour, give them $800 and go in there with a specific plan. I want to trade these US-based ETFs and I want your help finding replacements for them. And that might cost you some money, but you could bang that out in an hour or two meeting and then you'd have that list for yourself and then you're good to go. So that's what I would recommend. Don't ask me. I could definitely steer you wrong there because I just don't know much about the European markets. Okay, the YouTube and Reddit community that is obsessed with dividends doesn't fully understand free cash flow yields and earnings growth. The value of dividend stocks is diversification from mega growth. There is some value to dividend stocks. So what I would point to people, if there's anybody who's like really upset with me right now, thinking that I basically just said avoid dividends at all costs. Let me see if I can just on the fly find the right one. There is a live stream where I feel like it was recent-ish, like within the last year, where I explained dividends. I went over what they are, and there's basically several situations where you could still make a case for holding dividends. Is this it? Sounds like it. This is the TikTok fails person. Oh yeah, this girl. I have nothing against her specifically. She just gives insanely terrible dividend advice. Unfortunately, I won't be able to find it on the fly, but there is an argument to be made that dividend-paying stocks, especially ones that are on the aristocrat list, are a little bit more protected against downturns. For example, Coca-Cola works really well as a safety position. Gold and utilities are the best, but Coke is probably a strong third place. And that is essentially happening because of that dividend yield. It is a stable company. It increases dividends. It's got great cash flow. But also, the lower the stock goes, the higher that yield goes, and more buyers might come in. So you could certainly make a case that there's a place in a person's portfolio for a little bit of an allocation to much more stable, long-term dividend stocks. Nothing wrong with that. My only beef, and I want to be super clear, is the concept that you're making money. You're not making one penny doing that. I've beat that horse to death. You're not making any money. It's not passive income. Do not spend your dividends because your portfolio is bleeding capital when you're getting your dividends. Don't make that mistake in retirement that you think you can just spend your dividends indefinitely and you can just, once I hit 10 grand, this is another thing, the gurus online. Once I hit 10,000, I'm out, I'm retired for life. No, you're not, because your portfolio bleeds the 10,000. Okay. But dividend investing itself, I have no issue with that if you understand why you're doing it. It's not for the income, because there isn't any. It's for the fundamental differences in how a dividend stock will move in the market compared to something like Nvidia or Tesla. There are differences. Please don't invest in dividends for the dividend itself. That is quite an uneducated view on what a dividend is. And that's why, again, I say no actual investors talk that way. Only the Twitter gurus talk that way. But lots of asset managers hold stocks that pay dividends. Don't get me wrong. There's nothing wrong with that. So, yeah, go for it. I probably was a little bit careless with my wording, just based on that one person's comment. I don't know if I misspoke or whether he misunderstood, but yeah, hopefully I've been clear enough. I don't think I have. I'm going to have to circle back to this in the future. But yes, anyway, 1 hour, 10 minutes, pretty good. I'll definitely be coming back next week. I've got a ton of topics to get to. And this one intrigued me specifically. I like these things. So expect a follow-up to this. If anybody is interested, like, is investing really that easy? You just, VIX over 30, you just buy the SVXY, and when it gets below 18, you're out. We're going to put that one to the test. All right. So take care, everybody. I will see you next week.